The biggest challenge that most investors face is what to do when a stock market downturn occurs. And so in today's video, what we're going to talk about is what does the average stock market downturn look like in any given year, and some smart things for somebody to have in place or be prepared for when those downturns inevitably occur. Welcome to Couple Bowl. My name is Michael Dunham, and with me today is Patrick Fontana, the founder of Fontana Financial Planning.
Welcome, Michael. Cheers.
So, Patrick, I want to start today's episode by just asking you the simple question: what does the average stock market downturn look like? And so to tee this up, we're going to go ahead and put up on the screen right now what we call the red dot chart, which is something that we look at with every single client, every single time we meet with them. And so I'd like to kick it off by asking you the question of what are these red dots, or what does the average stock market downturn look like?
Absolutely. So the average is minus 15%. And if you look at this chart, you'll see every single year there is a red dot, and they are a little bit all over the map. But if you average them, the 1 year average minus 15. So to put dollar figures on that, if you start out January with $1 million and you have a decent expectation that could go to 850, it's a big number. The red dots are ugly.
Very true. And a couple lessons I'll pull from this, or I like to bring up whenever we go through this with clients, is one, you mentioned minus 15 is the average, but if we pay attention to the individual numbers, we'll notice that many of them are much uglier than that. And so a couple that I'll point out: this year alone, we're in 2025, our red dot was minus 19%. We're already back to all-time highs here as we record this in mid-July. But earlier this year, we were down 19% from the high. A couple years ago in 2022, we were minus 25%. And a lot of the watchers, a lot of the viewers will remember COVID, when we were minus 34%. And that happened in 19 trading days. The ugliest red dot that we can see, if we look throughout the history of this red dot chart back to 1980, would be 2008, when we were down minus 49%. So while the average is minus 15%, there are many instances that we've seen of much uglier downturns than that average.
Yeah, I like to look at, and what's really what I've experienced the last 25 years in real time is what the high point of the market to the low point of the market is. And so some of these red dots, the market was higher than what this chart reflects. And so this year, for example, it was more than a 20% move because the market was positive territory before it went to negative 19. And the expectation when we look at this chart, we like to lay out kind of two lessons or two rules the first time we meet with someone, and constantly remind them of, the first thing is, what is the next bar going to be? And this year we're showing on the right-hand side, it's up 8.5, kind of high point for the year. But by the end of December, that'll be the only time we know what it actually is. So each bar locks in at the end of each year. And right now, at any point during the year, we don't know where it's actually going to end up until the year's over.
So Patrick, one question I'd like to ask you. So we know that these red dots are going to occur. What are smart things that investors can do to, one, prepare themselves for these red dots, and two, make sure that when the red dots happen, they're doing the smart things and not the emotional or reactional things?
So the first big thing we like to do is have a emergency fund or war chest in place, so that some of the money that we need in the short term, is available and not subject to these red dots. The second thing is, when they do happen, to rebalance and essentially take the portfolio back into whatever allocation it should be in, and which is essentially a smart way, without involving any kind of emotion, to buy low and sell high, right? Rebalancing when we're constantly adding money to what's done the worst from what's done the best, we are buying on the red dot rather than selling.
One thing I'll add too, and this is where a financial plan is so important, but red dots do present great opportunities to make smart tax moves. So a couple ideas I'll bring up. One, tax loss harvesting. So when the market downturn occurs, not everything is going to be down to the same level or the same extent. And so having good discipline to go in there and realize losses for tax purposes, and you can take the money and purchase something else that's similar but different. That's a great opportunity to take advantage of when the market is down. front loading tax deferred accounts. So if your plan is to fund a Roth IRA or a 401k or some sort of tax advantaged vehicle, if you have not done that when the market is down, it's a great opportunity to do it at that point in time. And then Roth IRA, for example, if you fund your Roth IRA when the market's down and then it comes back 20% back to the highs, we don't know how long that's going to take, but we do know that that recovery will be tax-free because it happened inside of your Roth IRA. Third and last example I'll give is Roth conversion. So if somebody's planning on taking some of their IRA money and flipping it over to Roth, if you do that during a market downturn when you're on a red dot, it allows you to convert more shares for the same tax cost. And so there can be smart planning moves to make when the red dots happen. That said, you have to have a financial plan and you have to have that list of what are the things I'm looking to accomplish this year to be ready to react in the right way when those red dots occur. So with that said, you hinted at the gray bars earlier, Patrick, which is what the market has done every year going back to 1980. So tell us a little bit about the lessons that you like to talk through on the gray bars.
So from an expectation point of view, we're bullish as investors, and a lot of folks come to us with an idea of what they think is going to happen. And so one of the first things we need to agree on is that we don't know, either of us, what's going to happen in the short term. But we do know what happens in the long term is that when you look at the average of these bars over this entire chart, it's about 10%. Individually, there's one time on this chart that actually says 10%, but it wasn't 10. It was actually 9.8 or so, but they rounded up. It's never done 10. It averages 10. So having an expectation not to expect 10 on a yearly basis, but over time, it's a decent expectation. When you continually add money, you stick to the plan and you have discipline, that's where you can buy on every one of these red dots. And so I've been an investor for more than half this chart. And I've been putting away money consistently with discipline every single month, every single 2 weeks with 401k contributions, all those kind of things. And I can confidently say that I was an investor on every one of these red dots. I bought on all the red dots. And it doesn't take brilliance to do that. It takes a plan and it takes discipline. So if you start with that plan and you execute on it and you never hit pause or never sell on a red dot, you're always sticking to the plan and buying, you will succeed much more than if you react and have emotions and get affected by the red dot. So our investment policy statement as a firm, which we've done many meetings with all of our clients and lots of their children, grandchildren, we consistently come back to our investment policy statement being more and more simple. And what is our investment policy statement?
Never sell on a red dot. And so that is the biggest key to success, in our opinion, if you're going to be a stock market investor. And it is also the hardest thing to do because when the market is down and you see the balances in your account have decreased, emotions rise, and that's when it becomes very difficult to remain disciplined. And so thank you so much for joining us today. I'll say if you have any questions about your specific situation, we've got a link down below in the show notes that you can click on where you can schedule a complimentary introductory call with a member of our team. That said, Patrick, how do you want to wrap up today?
Rebalance with discipline.
Rebalance with discipline.
Buy on the red dots.